didn't realize
Kelly,
you
nice to
guys
see
had
you.
such a high, and you've had that high price target all year, right?
Yeah, we came out with that price target in our Barron's Outlook in December 2022 for year-end 23. We had been more concerned about an early in the year recession that may clear the decks, but really what we're seeing now is a delayed recession, and investors are in wait and see mode for the last couple of weeks as they're worried about three flat factors, which is inflation, central bank movements, and the economy. And I think there's an opportunity cost of keeping money in cash when you can earn greater returns, even still now in areas such as high quality, high yield on the fixed income side, real assets such as infrastructure, and a balanced portfolio, not only for tech stocks, which have more tailwinds than just artificial intelligence, but dividend growers, which look cheap to us as they've been out of favor.
If you had told people back in December, and you tried to, which was basically, hey, if we're going to have a recession, we get a rebound 4,700. And now I guess if we don't, we could get to 47. Like it's just a strange mix of events where it seems like everywhere you look, it points to up. And I just don't know how long that's sustainable.
Yeah, I mean, this is the most talked about recession that so far hasn't happened. And, everybody had been expecting it and waiting on the sidelines. Now what we're looking at is probably 1 to 2 more rate hikes and then a Fed pause. If you look at history, equities and fixed income tend to outperform when the Fed pauses. And with the delayed recession and consumer and employment markets remaining strong, yes, they are showing some cracks, but not enough to put us into a recession this year. I think these tailwinds of moderating inflation, artificial intelligence, which people weren't really talking as much about late last year, will continue to be strong for the markets. And that's why there's likely more upside from here as we get into Q2 earnings. Also, we'll be watching for companies and how much they can maintain price versus lowering price to take market share. But with moderating inflation, that might also be helpful to their margins.
What do you do with tech, right? Is it a case of, lean into the strength, go with it, or are you, looking elsewhere? Or does it just not matter? Is this just a case of the S&P will kind of protect you no matter what?
If you look at the technicals, when the Nasdaq is up this strongly in the first half of the year, the majority of the time it will continue to be strong in the second half, but not to this degree. Beyond just artificial intelligence, which was a huge tailwind for tech earlier this year, there's also other tailwinds for tech, such as moderating inflation is positive for long duration stocks. It's lower yields will also be positive for technology. And if the economy slows but doesn't go into a recession, we're going to be looking to own those companies that are less dependent on economic growth. That is all positive for tech. So it does put them in the sweet spot. And if you look at tech valuations, I agree they're not cheap, but they have a lot of positives going for them. But then beyond tech, a lot of other areas really haven't caught up. So I think there's other areas of the market that look cheap. We saw transports catching up as the market starts to believe that economic growth is going to remain fairly stable.
What about the banks, where you've got a couple of specific ones here? We've been talking kind of more generally, but Morgan Stanley and ING are on this list. Why?
So generally, we've been negative on the banks for quite a long time now, and that's because we think that beyond the mini banking crisis that we saw, higher capital requirements for the banks, more competition for deposits, and more regulation. So we're sticking to high-quality banks that are in well-diversified businesses, such as Morgan Stanley and ING, which over in Europe has had less issues in the banking system than the U.S. had, but overall not positive on the sector. And just going back to our 4,700 price target, what we'd really like to see in order for the markets to get to that level is broader participation beyond technology. So we're happy to see when small caps start to play catch up, when we see transports starting to hit new highs, all of that is positive because we want more market participation for the markets to keep climbing higher.
Yeah, and it just makes me laugh because we've been talking so much about one versus the other. Is it big tech or is it small caps? And today the Nasdaq and the Russell are both up 1.5%.
Yeah, and I think that's positive for the markets overall.
Yeah, definitely a sign of broad strength. Saira, thanks so much. We appreciate it.